Welcome to this episode of our property investing channel, where we bring you practical tips and strategies to help you maximize your profit and reduce your risk in your property investing journey. This is your host, Ami Sahat, and today we're going to be talking about mortgages, ways to increase your borrowing capacity and getting the best rates. And in order to explore this topic, I have invited Mohit Pachauri, Director of Capital for Castles, who is an experienced mortgage broker. So without further ado, I'd like to welcome Mohit to our show. Mohit, thank you very much for being here.
Thanks, Amir. Thanks for having me.
My pleasure. So tell us a bit about yourself, your experience and your journey.
Sure. So, Capital for Castles is a family-owned business. Myself and my wife, Jody, we are the co-directors and principal mortgage broker at the business. We have been doing mortgage broking for almost 5 years now, but the Capital for Castles was established in April 2020. We are based in Melbourne, Coburg area in Victoria, and yeah, look, the business is going well, and considering it's a family business, everyone is involved in it, including our kids as
That's
well.
fantastic. That's fantastic. You're based in Melbourne, but you can basically help people all around Australia. Am I right?
100%, yeah. So we do
Perfect.
have clients in Queensland and New South Wales as well, and some investors in Australia coming on board now.
Perfect. So in general, just to give us, our audience, a bit of information about the mortgage broking and what you do basically.
Sure, sure. So, I mean, I think the mortgage broking is much more than getting documents from someone and getting them helping them getting a home loan. It goes much further than that in terms of the care and the commitment and the responsibility it involves on mortgage brokers. So, what we essentially do is that we basically help people get a home loan in a nutshell, right? Now, there's services that go beyond just getting them a home loan, which we'll discuss down the track. Um, but it's all about love, care, and the support that we can provide to the buyers in getting the home loan.
So there is a service side of it and the quality of service that you can provide to a client. And there is another side to it, which is financial benefits. So tell us the advantage of using a mortgage broker comparing to going directly to a bank and just applying for a loan ourselves, because it is not that hard. Why people basically can use your service, and what is the financial benefits that they can get out of it?
Sure, sure. So, look, mortgage brokers and bankers, they deliver you the same product, but the way of delivery and what is involved is can be quite different. To give you some examples, mortgage brokers are abide by a duty which is called BID, which is best interest duty. It's a compliance and ethic requirement that we must act in the best interest of our client, whereas that may not apply to the bankers. The another important distinction is that we have got access to a suite of lenders that offer a suite of products that will that can suit every client's individual financial circumstances and their requirements and objectives. Whereas if you go to a particular lender, they only have a limited suite of products that they can offer to the client, which may or may not suit their short-term or the long-term goals. Um, and last thing, and this is my most favorite one as well. This is the service beyond settlement. So mortgage brokers' responsibility and their commitment towards the client doesn't end when the loan settles. It goes beyond that. It goes to the life of the loan to look after that client and make sure they are always on the right track as far as their mortgage is concerned. And if they are not, then we facilitate that change to make sure they come back on track. That's something may lag behind with when you're dealing directly with the bank.
And that was a fantastic thing that people need to consider, because if you don't ask, a lender will never give you a discount, or they will never give you the best options. And the way that you do business is that you take care of them and you continuously think about the best product that can suit a client according to the financial needs, and you let them know. And when you let them know, they can get the best result. Otherwise, they are basically dealing with the same bank and paying the same amount of interest rate, which they can easily pay less if they use a mortgage broker service. Correct?
Yeah, that's right. And there's so much involved in the Stay in Touch program, and the services post loan settlement. Like, we get in touch with our clients every 3 to 6 months just to see how things are going. We do their annual rate review, their objectives and requirements review every 12 months to make sure they're getting the most out of their home loans. Um, and that's something I think that is, it may not be available from every lender that you deal with them directly. So we do offer a value for the services that we offer.
So how many banks do you normally work with in terms of numbers? Is it 50, 60, 20? How many is that?
Yeah, so we've got access to more than 60 lenders in our panel. And that goes all the way from Big Four to the non-conforming lenders as well. So the availability of the product, availability of the solution is never an issue.
And that is an amazing point to consider, because when people go directly to banks, they cannot basically go to 60 banks themselves.
Yeah.
And normally they go to Big Four or maybe a couple of other banks, and they say that bank gave me the best rate, and they haven't explored all their options. And I think one of the benefits of a mortgage broker is that they analyze 60 banks and just give the client this is the best product for you according to your situation. Am I right?
Spot on, spot on. Look, getting a home loan is quite an exhaustive process. You got to go through all the documents, make sure everything is within the date range. Then you submit the application, you follow up with the lender. There's quite a bit involved, and it can be quite stressful, especially for the first home buyers as well. That's our role, that we take on their stress so they can still be excited about buying their first home or buying their first investment property for that matter. And we are there just to guide them and hold their hand to the finishing line.
And it is very interesting. Many people involve themselves in so much paperwork and applying directly to different banks that they forget the full picture. And they forget the service that a mortgage broker, a good mortgage broker, can basically offer to them, because they can basically hold their hand in the process and let them know about many things that they can easily forget. I've seen times and times that people start their property hunting without even knowing their maximum borrowing capacity.
Yeah.
Without knowing how it's gonna affect them down the line, because they are starting their journey. And whenever you ask them what is your budget, they say, oh, we were still in the process with the bank, but we just decided just to start the process. And in many cases they are searching in the wrong suburbs, because at the end of the day they cannot afford to buy in that suburb, and they are wasting their valuable time. But using a mortgage broker early in the stage can give them a high level good idea of what they can afford, their maximum borrowing capacity and maximum purchasing price, without getting involved in all those paperwork and submitting to different banks just to secure that best rate. So
Spot on.
that is very important.
It is 100%. And look, I think the awareness amongst the buyers and mortgage holders is increasing very rapidly, because currently more than 70% of mortgages in Australia are originated by mortgage brokers. So I think that awareness is increasing, which is great. And not only that, when you look at a list of different lenders, right? Your borrowing capacity may change from one lender to another lender depending on how they assess your financial circumstances. When you go to a bank, they will just give you the number based on their requirements. We go to so many different lenders to find out where they can maximize their capacity so they can make their purchase.
I think that sort of thinking comes from that one size fits all, type of thinking. It's a very common question. People always ask, what is the best bank for me? Which bank gives the best interest rate? But the question is really not that valid because it really depends on the financial situation, the risk profile, the circumstances of every person, and the bank requirements. So the best bank for me is completely different to the best bank for you. So
Person.
people really need to understand that because their friend goes to NAB, it is not necessarily means that NAB is the best bank for them. And I think that's a very common mistake that lots of especially first home buyers make.
Yeah, 100%. And look, in the current market where the interest rates, the whole market, lending market is so volatile right now, you go and choose a bank based on their interest rate being so cheaper. If it's a variable interest rate, they may be more expensive in week or 2 weeks time. And that's what I think people need to understand, that shopping around between different lenders just based on the cheapest variable rates is not necessarily the right way to go about it all the time. You should look at what are your financial objectives, what are your goals and plans, and then see how that works. And then based on that, a good mortgage broker will take out to 60 lenders and say, you know what, these many lenders will suit your requirement. And among these, this is the most competitive option for you.
Absolutely, absolutely. And I'm sure many people seen this many times that, on paper, a bank gives a very good interest rate, but at the end of the day, with all the
Yeah.
hidden fees and costs and, the rates is not competitive at all.
Yeah.
And this is something that a mortgage broker can easily pick, but a normal person without having those financial background and, the assessments method that mortgage brokers use, they basically cannot pick those things.
That's right, and that's what we are there to break down that process and make sure we can explain them the numbers and everything in their own language, so it's easier for them to understand rather than using all the jargons.
Absolutely. But it happens every now and then. I hear from clients or family or friends that they have secured an interest rate with a bank that is lower than what mortgage brokers offer them initially. Why is that?
Yeah, sure. So look, it does depend on the lender to lender as well. Sometimes when clients are negotiating, especially if it's an existing loan with a particular lender, banks are getting very heavy on the retention side now. So they want to retain each and every single client. Just like you and I, we want to retain our clients as well.
Absolutely.
And in doing so, sometimes they may offer customer who are approaching them directly a little bit lower rates than what brokers can do as well. Now, we do have some liberty to request some additional discount as well. But when a client comes to us and say, hey, I'm looking at looking at refinancing my home loan, what do we do? Our first word of advice is, have you spoken to your existing broker or have you spoken to your existing lender? Do that first, and then we can still give you the options that are available in the market, and then you make the choice. So it
Yeah.
always starts with their existing relationship.
Absolutely. Understanding our option, I think, is the first step. And then, making the right decision after analyzing all those options is the second one. So
100%.
let's go deeper, just talk about more complicated financial matters in mortgage broking sector. So many people try to buy through their super fund or SMSF. So just tell us a bit of information about how does it basically affect the borrowing capacity, and what are the requirements in terms of maximum LVR or other requirements or other limitations comparing to a situation where you buy under your personal name?
Sure. So under SMSF, the main requirement or a couple of main requirements are, first, it has to be an investment property. It can't be for yourself to live in. The second one is that it can't be a construction. So where there is a progress drawdown payments involved, banks don't accept that. So it has to be established property, or it can be an off-the-plan property as well. Now, in terms of LVR requirements, how much they can borrow, it's very similar to your normal personal name residential lending. So the higher the LVR, the interest rates are higher as well. 99% of the lenders, they only go up to 80%
Mm-hmm.
of the purchase price. So you have to have 20% deposit, but they always prefer the lower LVR, so their risk is minimized. Look, other than that, as far as the borrowing capacity is concerned, SMSF servicing is done based on the income and expenses and the liabilities that are present in that trust fund. So, you know, if if our mom or dad's account, if they were going to get a property under their SMSF, it will be the rental income that they can expect from the SMSF property, plus their ongoing superannuation contribution from their normal day-to-day job, if they don't have any other properties present in SMSF. And it's very simple and straightforward in that aspect because it doesn't involve a lot of different entities. But then again, there are quite a few restrictions in terms of lenders, like, you know, major lenders are not part of the SMSF anymore.
Mm-hmm.
So you only find um, specialized lenders who will allow SMSF lending, and from time to time they can have postcode restrictions as well in certain states. Some of these lenders who do offer SMSF lending, you probably may not have heard their name in
Mm.
day-to-day life, right? So they are specialized lenders which may not be available, which, you know, people may not know about investigating with them. It's not necessarily a very complicated structure or complicated way of lending compared to personal lending, but there are a few criteria that you must meet in order for you to borrow under SMSF structure.
Absolutely, absolutely. Another structure that many investors are interested in is using a family trust when they're investing. So using a family trust, especially with a company trustee, gives investors a couple of benefits. One is tax purposes in terms of optimizing tax and, you know, distributing profit to the people with lower income, which reduces the tax legally, and also asset protection. So we're seeing more demand of investors wanting to invest in that particular structure, family trust with corporate trustee. So how does using that particular structure affects the borrowing capacity, and what are the limitations and restrictions on that?
Sure. So borrowing under trust is not a major issue as long as the family trust is purely set up to hold the assets. It's not a trading trust. That's what majority of the lenders want to look at. And then again, with the corporate trustee being involved, they would get some income as so with the corporate trustee, they will have some directors and shareholders and beneficiaries. Depending on how they derive their income from the business, then it can be included in the borrowing capacity. Some lenders could allow the trust distribution that's going to the minors as well, and I think it's capped at around $416 per
Yeah,
minor,
something around that.
something around that mark. So if it's to answer your question, look, the lending is fairly straightforward with a family trust as well under investment. 80% LVR and below that, that's quite ideal. Anything above 80% when we have to involve lender's mortgage insurance, it can get a little bit tricky in terms of getting the approval, but it's not something that's unheard of.
And like SMSF, not all banks are interested in lending to family trust, correct?
Well, family trust, you will find that some lenders will specialize in that, but you definitely have a wider range of lenders available for the family trust as compared to the SMSF. So if you've got a family trust and a corporate trustee that is not trading, that's a simple structure, easier to get through. But the other structure where the company is trading and maybe there's a partnership involved, so there's another entity involved there as well. It's not that lender is going to say no, we can definitely not explore that option. It is there for people to use as long as it ticks all the boxes and the borrowing capacity and the income that is being derived from the business can be used correctly. Just complicates the matter, but at the same time, if it's in their best interest and that's what's been advised to them by their financial planner or accountant, that's fine. That definitely can be worked with.
Absolutely makes sense. So you mentioned LMI a few times. So how do you see LMI? Is it a friend for purchasers that can help them to buy a property when they don't have that 20% deposit, or is it something that they should avoid?
Yeah, good question and very tricky question as well.
Yes.
Look, I think it really depends on their financial circumstances, right? So if you are loan deposit and you want to buy a property because it's going to take you X amount of number of years to be able to save 20% deposit, LMI is a great friend. It
Absolutely.
allows you to enter the property market sooner rather than later and then start their future. Um, at the same time, if you do have sufficient deposit, because I've had some customer who said, I've got 20% deposit, but I don't want to put the entire money in the home loan. How about if I go and borrow under LMI? That's fine. That's the decision they want to make. That's fine as well. But there are costs associated because it's when the LMI gets added on your home loan over a period of 30 years, the compound interest could be quite high.
Yeah.
So there is financial side of it as well. But if someone wants to keep that 5% deposit to cater for, going on holidays or starting a family or getting married, then LMI can be a good friend for them as well. It is at the end of the day an expense. If you could avoid, then avoid it so you don't have to pay interest on it. But some people's circumstances don't allow that. In that case, it's a great friend.
Absolutely. And especially for the people that you mentioned, they have enough capital to invest for that 20%, but they prefer just to do other things with that money. So it comes to a basically analysis and assessment of, financial assessment to give them the option which one is better to proceed with. So there is a correlation between LVR and LMI, and there is a sweet spot where you can basically meet the best words. So if you basically go too much in LVR, you're gonna pay a huge amount of LMI. And if you reduce that LVR, you have to pay more deposit. So where is that sweet spot for the people who have that money and, just want to make the best decision?
Yeah. So look, you're right. The LMI does increase as the LVR increases as well, and it really spikes up when you borrow more than 90%. So for first home buyers or next home buyers, that's what they need to look at. That keep your LVR below 90% as much as possible. For investors, your maximum you can borrow is 90%. So around 80 to 83% kind of mark. If you keep that, your LMI should be quite small, depending on the value of the property as well. So look, I've had clients who had 20%, more than 20% deposit to buy a property, but then they decided to pay a little bit of LMI and buy two properties. So some people decide to do that as well. It does really come down to what their financial circumstances are as of now and what their future goals and requirements are.
Absolutely. Understanding the numbers and making an informed decision based on different scenarios.
That's right. And for first home buyers, there are some lenders who've got a scheme where you only pay $1 for the LMI if your LVR is 85% and below.
Mm.
So 85 to 86% kind of mark seems to be like the sweet spot for the first home buyers, and investors around it under 85% as well.
Perfect. Very, very interesting points. Another question that many people normally ask is that how they can maximize their borrowing capacity. So we are basically looking at two different things. One is the one expenses, the other one is the income. So how different expenses affect borrowing capacity and how increasing the income basically affect that borrowing capacity.
Yeah, sure. So when lenders look at calculating the borrowing capacity, it's a simple mathematical calculation, right? It's income minus the expenses and the liabilities, as you mentioned. So the way to maximize your borrowing capacity is minimize your debts or get rid of debts as much as you can and reduce your expenses as well. So expenses within lending, there is a terminology which is called HEMS, which is household expenditure measurements. And what that tells us is that there is a set benchmark for the expenses in Australia for people living in different states, whether they are single or they're joint, whether they have one dependent or more than one dependent, and what their income is like as well. And based on that, then banks determine what expenses we should be using. So as long as your expenses are below that benchmark, then you're fairly operating at an optimized level. But if your expenses are quite high, then it could be time to tone down those expenses and make sure that those expenses remain that at a toned down level so you can afford a property. And that's what we can go through it when we do a pre-assessment, when we're speaking to the clients to see where their expenses are at.
So for instance, a car loan for a client, if they are in that range that you mentioned, that normal range is okay. But for a person who has a very high amount of car loan, you prefer them to have a lower amount of loan for car. Is this how you do it? Or
That's right. And it does depend on how much is the balance, how much is their monthly repayments, and what's the total limit outstanding on the car loan or any personal loans. But the way lenders assess this is that they put a buffer on their existing commitments, especially liabilities. So if your repayments, let's say if it's an investor, they've got a home loan and their repayment is $2,000 per month, lenders will generally assess it at 3.5, 4,500 kind of mark. Just so in case in future, if the commitments or the expense liabilities were to rise, they can still cater for that and not find themselves in a financial strife. So the lower the loan amount and the lower the repayments, the higher the borrowing capacity. If you have funds set aside to be able to pay off that home loan or that liability, then it substantially increases your borrowing capacity as well.
So the same concept, I think, goes to credit cards.
Same concept, yeah. So some people think that I've got a $15,000 limit, for example, but I barely use it. I only use $1,000 or $2,000 per month and I pay it off straight away. Banks will still assess it at $15,000 limit because that's the limit that's available for them to use at any time.
So the best way of basically improving that maximum borrowing capacity for a person who doesn't use that credit card is basically closing that credit card, is it?
Yeah, 100%. Yeah.
Yeah.
Closed on the credit card. Yeah. And look, this is another point of difference with the mortgage brokers as well. When we get an assessment or details from a prospective client, we don't just say that, you know what, here are the numbers, go for your life, that's all you can do. We try and work on, give them a solution that, maybe try reducing your credit card, pay off your card loan so you can buy another investment property, etc. We work with them, which they may not get directly with banks or anyone else.
Fantastic, Mohit. So how can people find you?
Look, we are widely available on the marketing. We are very marketing focused people. You can go on to capitalforcastles.com.au. We've got all the details there. There's a Facebook page, Instagram page, LinkedIn, and Google My Business as well. We've got about 120 five-star Google reviews now, so it's fairly easier to find us these days.
You're everywhere, mate. That's very good. Well done. So thank you very much, Mohit, for being here today and sharing with my audience. I really appreciate you.
No problems. It was my pleasure, and thanks for having us as well.
So if you liked what you've heard today, please like our channel and leave us comments. And on that note, this episode is a wrap. I will see you guys again very soon. Bye for now.